Hey traders, for today's trade we're looking at an option strategy known as a broken wing butterfly in streaming service Netflix. So taking a look at the stock on MarketSmith, the stock has been pulling back over the past month after hitting a high of 379.43 in early February. Shares have undercut their 21-day and 50-day moving averages as well, which could be seen as bearish. Shares still maintain a decent 92 RS rating, and the relative strength line has not taken too much damage during the pullback. The day the stock undercut the 50-day line, Netflix traded lower in heavier volume, which is another red flag. But with a strong industry group rank at number 9, as well as future EPS growth expected in 2023 and 2024, this one likely isn't dead in the water just yet. So today's trade aims to profit from Netflix moving sideways then slightly lower. A broken wing butterfly with put options is created when an investor sells 2 puts at a given strike price, then buys one lower strike put and one higher strike put relative to the 2 short puts. The lower strike put is going to be further away from the short puts than the higher strike put. Each put in this setup will have the same underlying stock, the same expiration date, and a different strike price, except for the 2 short puts, which will have the same strike. With a broken wing butterfly with put options, you will receive a credit or premium for the trade. These spreads are designed to benefit from decreases in underlying volatility. The trade will make a profit even if the stock price goes down, as long as it does not exceed the credit spread strikes. If it does, the trade will start to lose money. On the upside, the trade has 0 risk. You will earn the biggest profit if the stock moves slightly lower towards the short put strikes. If the stock moves below the credit spread strikes, you'll end up with a loss. But the good news is that with your risk being defined, you know your worst case scenario in advance before you enter the trade. So now, with all of that said on this broken wing butterfly option trade, let's take a look at my trading platform and set up a real life example using Netflix. So with Netflix trading around $3.19 a share, here's how we'll want to set up this trade. Using the April 21st expiration, we're looking to buy one put with a 240 strike. Then we're looking to sell 2 puts. Same expiration. With a 280 strike. And then finally, we're looking to buy one put with a 300 strike. Using the April 21st expiration, we're looking to buy one put with a 240 strike, sell 2 puts with a 280 strike, and buy one put with a 300 strike. Notice that the upper strike put is 20 points away from the middle put and the lower put is 40 points away. The ideal scenario here is for Netflix to stay flat initially, then drift lower to close around 280 at expiration. The total profit zone is between 260 and 300. This broken wing butterfly trade can be placed with no cost, which means there is no risk on the upside. The worst that can happen is all the puts expire worthless, leaving the trader with a flat return. On the downside, though, the maximum loss can be calculated by taking the width between the upper and middle strikes, multiplying by 100, then subtracting the premium paid. That gives us, in this case, a maximum loss of $2,000. This is also equivalent to the maximum gain in this scenario. As always, remember that if you're new to options, make sure you practice first with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment in some cases. Check out the new Options Trader app from IBD for more digestible options education and tons of great trade ideas. And be sure to join us here for our regular content where we break down a new trade idea every day.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.